Hi, Kelly Fitzmaurice with my home group, K Grant Group.
And I'm Hannah Canaletti with the K Grant Group.
And here today, we are going to provide you a market update for about the first quarter of this year.
Yes, absolutely. So we wanted to touch on obviously the market update as well as some other things to consider when buying a home. So we wanted to start here and kind of talk about the 6 major things that we look for when you're looking for a good and sustainable investment. So a lot of people aren't familiar with this area. They come in and they're like, I want to buy in an area where I'll see a lot of appreciation. And there's 6 factors that we really focus on. So
yes, and those 6 factors are being close to an airport, being close to an entertainment district with restaurants and things to do, also being close to employment centers, 30 minutes to your employment center, freeway access, and I think I already said close to an airport. Am I missing anything else?
I don't think so.
Recreation. So like being close to a park.
Open areas, hiking, outdoor areas, green belts, things like that. So again, just to recap, close to the airport, freeway access, 30 minutes to most areas in the valley, being centrally located. So access to open areas and recreation, entertainment, and employment. Is your job nearby? Are there employment centers nearby? Which brings us to Peoria, which is a big growth area in the valley because it does check all of those boxes.
It does. And something to note that you typically, whenever we see this and we're looking for those 6 key factors, is residential will go in first, and then you will start seeing all the commercial side of that development to go in secondary. Also, there are rumors that in Deer Valley, there will be an airport that will be built in the next few years, which will also make that commute to that airport only 30 minutes.
Yeah, so keep an eye on Peoria. I think it could definitely be a good place as far as an investment goes. We also wanted to touch on CPI inflation. Obviously, inflation is a huge conversation right now. And if you look at this graph, housing takes up almost half of what is taken into consideration in the CPI.
It does, but here's the key factor of that. When we're looking at that 45%, one thing that is a big percentage of that is going to be shelter. Okay, so when we're talking shelter, we're talking about rentals, and we're talking about a hotel, we're talking about Airbnbs. So when you're actually paying for the shelter,
you're consuming housing,
exactly. Yes.
So when we look at this, if you're considering that whole graph, you have seen about 5.8% inflation since June of 2022. And Kelly and I talk a lot about real estate being a fantastic investment as a hedge against inflation. And we wanted to show this chart because it shows if you're a homeowner and you take out that piece because you're not renting, you're not consuming housing. So you've only seen about 2.1% inflation since June versus someone who maybe has an apartment rental and continues to rent or rents a single family home. They're getting hit a little bit harder. They're seeing about a 5.8% increase since June of 2022.
So another good reason to get a hold of us, and we can kind of talk you through, explain that a little bit more, because if you're a homeowner, you're going to be building up equity. There's also going to be tax benefits there too to be able to write off, whereas you're not going to be able to write off this inflation in this category.
And your mortgage payment is fixed for the most part. You have a fixed 30-year loan, so you're not seeing these ebbs and flows in rental costs and things like that. We also wanted to talk about unemployment. We're at about 2.5% in the greater Phoenix area, which is less than the rest of the United States, which is closer to about 3.8%.
Yeah, that's the national average right now.
And that's what's big in our area. They've made a major push, as Kelly's talked about before, in 2008, they've made a huge push to diversify our workforce.
So yes, our labor force back in 2008, we were very heavily concentrated just on the residential side and commercial side. We have since then have went through a diversified and planned. And so that's really what's helping us with our unemployment rate and our inflation rate for the greater Phoenix area right now.
Yeah, and there just continues to be more development. There's more companies coming here, which kind of leads us to a conversation about affordability. People talk a lot about how no one can afford homes in Arizona and the affordability is down, but the index is a little bit skewed with that because they are comparing income data from 2 years ago to home prices right now.
That seems really accurate.
Which seems really off when you think about it, because there are so many jobs. We've seen increase in wages, but there's so many jobs that are coming to this area that are higher paying jobs. So you have higher paying jobs coming in, you have wages going up, but they're comparing that data from income data from 2 years ago to today's home prices and saying, well, you know, affordability is a problem. So just wanted to toss that out there when we're looking at that.
We don't really have an accurate index to look at the median income right now, and the data is outdated. So we just wanted to touch on that point, because when you're hearing this in the news stories and things like that, once again, you want to reach out to us so we can kind of talk that through in the conversation with you, and you're not just always listening to those news headlines.
Absolutely. So we also wanted to touch on appreciation. So if you've owned your home for more than 3 years, or let's just say just about 3 years, you're looking today at about 21.3% appreciation, which is, I mean,
that's
really
still phenomenal.
Yeah.
And right now, anybody, if you come and talk to us, we're going to sit down and we're going to talk to you about how we can help you build your real estate profile, whether you're just starting as a first-time home buyer. But we're always going to suggest that you buy and hold for at least 5 years, 3 to 5 years, right? Because you're going to see that appreciation where you're seeing from April of 2021 until now, that's 21.3% of appreciation. So that is really kind of the model that we kind of live by, is that 3 to 5 years that we're going to tell you to buy and hold.
And, you know, obviously in this section here, you see there's that big peak when we peaked in May of 2022. And those were very artificially inflated prices because rates were, you know, sub 3%. So we did have a bit of a correction here. And now we're just kind of, it's been very balanced since then for the most part.
So also back here on that, when we were at that height, another couple of key factors you have to keep in mind, supply was at an all-time low, like very, very low, but the demand was through the roof, right? So you had people going over contract price, right? If we were to look at those graphs, you could see that how much dollar per square foot that was going above list price. We don't live in that market anymore. That was an insane market. We call that very out of balance and
artificially inflated.
Correct. Yes.
And so again, when we're talking price per square foot on a monthly average, price per square foot is up 26% as well. So keeping in mind, you know, again, like she said, if you know you're going to be in the area for 3 to 5 years, you know you want to own a home for that amount of time, you will see great appreciation. If you're planning to only purchase something, maybe hold it a year or two, you may want to consider that a little bit further.
And that's something we can dive into that for you too. If you are looking to get an investment property, you're a first-time home buyer, whatever your needs might be in real estate, we can kind of talk that through with you. We always dive into our dollar per square foot by zip codes, by cities, by subdivisions. That is where we live, and we can help you walk you through all of that.
So we also wanted to touch on luxury a little bit. So
luxury is very interesting right now.
It is interesting, and there's a lot of like back and forth feedback on luxury because we are having one of our best luxury seasons to date.
In a while.
In a long time, well, really ever with our luxury market. So, but you're still seeing a lot of these homes over $1 million, big price reductions. So then they're saying, well, how healthy can the luxury market be if we're seeing all these price reductions? Well, there's been a 46.2% increase in supply in that price point. Our contract ratios are also up. So our contract ratios for that price point are up a little under 17%, but our supply right now is outpacing the contract rates. So we're having a fantastic year. You know, luxury sales numbers are higher, but the supply is there too. So it kind of, you know, if you can't compete, if your home isn't staged, if your home isn't pristine, you are seeing price reductions there sitting longer.
And you know, it's an interesting conversation that I've been having with several of my clients that are in this particular market, right? And even talking about seasonality. And I said, listen, supply is up right now, so let's go take a look at these properties. We are going to continue to see price drops. Now, if that property is priced right and has all the bells and whistles, it may go quickly. But right now we are seeing that supply is on the market a little bit longer. It depends on where it is priced at, dollar per square foot.
There's a lot to choose from.
Yeah, and so we are going to keep on seeing price reductions in that, but that market overall is really moving our market. So anything over $1 million, we're seeing a lot of contracts there, but we are seeing, like Hannah said, the supply increase.
So yeah, so you may see higher days on market, you may see price reductions. It does not lend to the fact that our luxury market is still not very healthy.
And seasonality wise, typically, once it starts getting hot out, our over $1 million buyers, they're not going to be here shopping, right? So
Yeah.
we may see it be a little stagnant, which is a seasonality trend for the summer months that we're getting ready to go into.
And you always see it here. So this is weekly price reductions. As the temperatures go up, so do price reductions in this luxury market, because luxury buyers tend to leave this time of year. They're here January to about April, and then a lot of people clear out. So if your home hasn't sold by about April, you may see them start to drop their price because temperatures are up, price reductions are up.
And when we look at May, we're still going to see that this is up, but you got to remember the contracts on those homes the contracts were made and accepted by the seller in April, and they're not going to close until May, right? So we're really not going to see that seasonality kind of change in our graphics until about June.
June, July. And speaking of price reductions and concessions.
Seller concessions. We're still seeing that. So on this map, you can kind of see everything in the blue. More than 50% are paying seller concessions. Everything that's in the green is going to be less than 50% are giving seller concessions. Something to kind of note about these blue areas, this is still going to be where you have a lot of building going on. So we still have a lot of new home builders. We still have a lot of infrastructure that is going in. So that's where you're going to see a lot of that, because all the new home builds are giving fantastic seller concessions right now. We've been able to assist a lot of people with that. Right now, the average for the entire greater Phoenix area on the seller concession is about $9,000. I want to say $152 is the exact seller concession for the average right now.
Yeah. So if you are a buyer that is in need of seller concessions, you want that for a rate buy down, you want that to cover closing costs, you may want to kind of focus on these areas in the blue, because you're going to see, a lot of contracts across the board, a lot of sellers willing to offer those things.
And once again, it just really kind of depends on what you need, right? So if you're looking to sell, we can help you with that and work you through what it's going to look like selling your property. On the buy side, if you are needing that for the rate buy downs, or if you need the seller concession to help pay for closing costs, everybody's a little bit different with what they need, but we're here to kind of walk you through on what that looks like.
Absolutely. As far as our market index, we're pretty close to balance at this point. So reason being, our demand is pretty flat. So we're not seeing a huge decrease in demand, but when rates are still hovering over 7%, we've seen it before, we'll see it again. 7% buyers aren't wild about it. So it makes our demand a little bit more flat. Our supply isn't going up as steadily, but it is still rising. So when we have a rise in supply and flat demand, that index comes down a little bit. So we are dangerously close to balance, but not evenly distributed balance.
Absolutely not. And this is just something right now we are seeing that supply is just ticking up just a little bit. But as Hannah said, when those interest rates go up, the market tells us that demand will just stay flat because people are just not digging those interest rates. Anything really, I would say over 7% right now.
Yeah. So, and when we say it's not evenly distributed, you saw that graph at about, valley-wide, we're at about 110, which is pretty close to balance. But when you look at this, it is not evenly distributed whatsoever. You have cities like Chandler that are at a 220, meaning their seller market is on fire. Gilbert, same way. You have cities like Apache Junction, huge seller markets. When you look at this list, you'll notice the ones that are in a little bit of a chillier buyer market are on your outskirts.
Where the new builds are.
Where the new builds are, where resale isn't competing as well with new construction. And, you're further outside of the main city. A lot of people want to be a little bit closer into the major, within the major freeway systems. Those cities tend to fare a little bit better, but those are all resale. There's no more room to build, so there's no new construction to compete with.
But at the same time, in those new build communities, we can get you really good deals because of the seller concessions, and there's a lot of infrastructure that is taking place. And when we go back to our 6 key factors that we were discussing earlier, we can kind of talk that through with you in all these areas that are more in a buyer's market. But one of the things, and most of these buyer markets are going to be driven by all the new build communities that are out there. Another one I like to point out is Apache Junction. Holy moly, it's on fire. Apache Junction has just got a lot of things going on out there right now. there is a pocket out there that's really close to the East Mark area that's in Mesa. So Mesa and Apache Junction kind of border each other, and it's really not that far. So there's a lot of building, there's a lot of affordable houses out there. They're doing a lot with commercial as well in Apache Junction. So I think we're going to continue to see that in Apache Junction as well.
I think give it 3 to 5 years, it'll be a whole different world out there. I think it will be similar to what people thought about maybe Surprise a few years ago. It's kind of no man's land, and now it's its own, you know, fully functioning, beautiful little pocket. So keep an eye on some of these growth markets. Keep an eye on Levine. Keep an eye on Apache Junction. Keep an eye on Peoria. And those, from an investment standpoint, if that's your Santan Valley. So focus on those. Ask us for more information on some of those kind of hot markets that might be invest now, and look at it in 3 to 5 years and say, I'm glad I put my money there. So.
Yeah, we're here to help you with whatever you want your real estate portfolio to look like. And whether you are just starting out or you want to just come in and talk to us, we want to help you and guide you through that process. We are your real estate advisors, and don't hesitate to reach out to us.
Absolutely. And as always, thank you guys for tuning in. This is kind of our last little slide that just shows those top cities that are kind of really true top seller markets. So
I think it's very fitting with the Summer Olympics coming up.
This is true. But whatever questions you guys have, respond to this email or give us a call directly, and we are here to help.
Yes, we are. Have a great